A 3 ETF portfolio anyone can build in 15 minutes has outperformed most professionally managed accounts over the last 2 decades. Not because the strategy is clever, because it is not trying to be. Here is how it works and why the math is so difficult to argue with. The 99% figure in the title needs to be honest before the video earns it. The S&P SPIVA data, which S&P Global publishes annually to track active fund performance against index benchmarks, does not show 99% underperformance. It shows that over 15 years ending December 2023, approximately 92% of actively managed U.S. equity funds underperformed the S&P 500 index. The remaining gap to 99% comes from adding advisor fees on top of fund fees, and that combined cost structure is where most managed portfolios actually lose the comparison against a simple 3 ETF approach. The math is worth running in full. The portfolio uses 3 funds that together cover the entire global stock market and provide a stabilizing bond allocation. The allocation is simple, the products are available at any brokerage, and the total annual cost is approximately 0.04% or less. The first ETF is VTI, the Vanguard Total Stock Market ETF. VTI holds approximately 3,700 companies across the entire U.S. public market, from the largest mega-cap technology companies to small and mid-sized businesses, weighted by market capitalization. Its expense ratio is 0.03% per Vanguard's fund prospectus. The U.S. market accounts for approximately 60 to 65% of global equity market capitalization, making VTI the core engine of the portfolio's long-term growth. The second ETF is VXUS, the Vanguard Total International Stock ETF. VXUS holds approximately 8,600 companies across developed and emerging markets outside the United States, covering Europe, Asia, Latin America, and other regions. Its expense ratio is 0.07% per Vanguard's fund prospectus. International diversification ensures the portfolio is not dependent on any single country's economic performance and provides exposure to growth in economies where U.S. investors are otherwise entirely absent. The third ETF is BND, the Vanguard Total Bond Market ETF. BND holds over 10,000 U.S. bonds across government, corporate, and mortgage-backed securities with varying maturities, providing income and reducing overall portfolio volatility. Its expense ratio is 0.03% per Vanguard's fund prospectus. The bond allocation reduces the magnitude of drawdowns during equity market downturns and provides a behavioral buffer that makes staying invested during market crashes significantly easier for most investors. A standard starting allocation for an investor in their 30s with a long time horizon is 60% VTI, 30% VXUS, and 10% BND. An investor approaching retirement with a shorter time horizon and lower tolerance for volatility might shift to 40% VTI, 25% VXUS, and 35% BND. The exact split is adjustable to individual circumstances. The principle behind it is not. This is where the comparison against a professionally managed account becomes concrete and difficult to dismiss. A financial advisor who charges the industry standard 1% AUM fee, as documented in Kitsa's research on advisor fee benchmarks, adds that cost annually on top of whatever expense ratios the underlying funds in the advised account carry. Morningstar's 2023 U.S. fund fee study found that the average expense ratio across actively managed U.S. equity funds is approximately 0.66%. Combined, an investor in a typical advised account with actively managed funds pays approximately 1.5 to 1.7% per year in total costs before any taxes on distributions. The 3 ETF portfolio using VTI, VXUS, and BND carries a blended expense ratio of approximately 0.04% annually. There is no advisor fee because the investor manages the portfolio directly with no ongoing professional involvement required. On a $300,000 portfolio held for 30 years, the cost difference produces a result that is hard to dismiss. Assuming an 8% average annual gross return, the 3 ETF portfolio at 0.04% costs grows to approximately $3,009,000. The same portfolio at 6.4% net return after 1.6% total annual costs grows to approximately $1,943,000. The difference is approximately $1,066,000 in wealth that exists in one account and does not exist in the other. That gap is generated entirely by the cost differential, with no difference in the underlying market exposure or investment philosophy between the two approaches. The fee disadvantage alone would justify the 3 ETF approach, but the SPIVA performance data makes the case significantly stronger. According to S&P Global's SPIVA US Year-End 2023 scorecard, 92.2% of all actively managed U.S. large-cap equity funds underperformed the S&P 500 index over the 15-year period ending December 2023. Over 20 years, the underperformance rate reaches approximately 95% according to the same data series. This means that even before accounting for advisor fees, the vast majority of active funds used inside managed accounts generate lower returns than the simple index approach that the Three-ETF portfolio captures. An investor paying a 1% advisor fee on top of a fund that is itself underperforming the index faces a double disadvantage: lower gross returns from active management and higher costs from the advisor fee layered on top of that underperformance. The 99% figure in the title is directionally honest when both layers of this cost and performance gap are counted together. After fees and after the documented underperformance rate of active management, the population of professionally managed accounts that consistently outperforms a simple 3-ETF portfolio over 15 or more years is genuinely very small by any honest reading of the available data. This comparison would be incomplete without acknowledging what the 3-ETF portfolio does not do. It does not provide tax planning, estate planning, insurance analysis, retirement income sequencing, or behavioral coaching during market downturns. A skilled fee-only financial advisor who charges by the hour or a flat annual retainer rather than a percentage of assets can provide genuine and measurable value in each of these areas without creating the AUM fee drag that undermines long-term investment returns. The problem is not financial advice. The problem is a compensation model where the advisor's revenue scales with assets under management, creating a structural incentive to keep assets in an account rather than redirect them to pay down high-interest debt, fund specific near-term goals, or invest in ways that reduce the advisor's own fee base. The 3-ETF portfolio is not an argument against financial planning. It is an argument against paying a percentage of your total wealth annually for investment management that the data shows most active managers cannot justify on a net return basis. Building the portfolio requires opening a brokerage account at Vanguard, Fidelity, or Schwab, purchasing the 3 funds in the ratio appropriate for your time horizon and risk tolerance, and setting up automatic contributions where the account type allows. Rebalancing once or twice per year by selling the overweight position and buying the underweight one to restore the target allocation is the only ongoing maintenance required. The entire management process from initial setup to annual rebalancing takes a few hours per year at most. The simplicity is not a weakness. It is the mechanism through which most of the performance advantage is generated, because the portfolio never incurs transaction costs from active trading, never drifts into concentrated positions based on short-term market views, and never generates unnecessary taxable events from position changes driven by fund manager discretion rather than the investor's own goals. 3 ETFs, 15 minutes to set up, and a fee structure that keeps approximately 1.5% more of the portfolio's gross return working for the investor every single year. The math produces an outcome over 30 years that most managed portfolios, despite having professional management and much higher costs, do not match. The portfolio wins not because it is sophisticated. It wins because it is not. If this breakdown gave you a clearer picture of how to structure a long-term portfolio that works in your favor rather than against it, subscribe, because every week we break down the investment strategies that actually hold up when the numbers are run in full.